Let's just start off with market activity in general. Investors still sitting on the fence, not wanting to take opportunity of lower valuations in the market. What do you make of the NSE All Share in general?
Absolutely. We will continue to see a lack of confidence in the equity market so far from investors. Today, the market returned 0.27% negative, and all the sectorial indices were also down. They were all negative, with the highest loss coming out of the food and beverage sector that lost about 1.8%. And I mean, generally, investors are just cautious. We're seeing stocks across various sectors that are trading at very attractive levels. We think that across the sectors, whether you're looking at banking, the breweries, the food and beverage, there are quite a number of companies that are trading at a deep discount to their fair values. But I think investors are just generally concerned about more macro issues, and as such, they are not really taking advantage of the depressed prices we're seeing in the market. Let's
talk about the results that are coming through. The Tier 1 banks and some of the Tier 2 banks have done particularly well, so we know that story. Let's talk about the consumer goods stocks and what we're seeing in that particular area. Unilever's showing strong growth, up 16.8% year on year, and I think it just speaks to all these expectations about the growing middle class in Nigeria and the growing consumerism in the country.
Yes, you are right. Unilever's result was generally in line with our expectation. They had a top-line growth of around 15%, and then bottom line growth of about 36% growth in PBT and 32% in PAT. Generally, the performance of Unilever is in line with our expectation. We're seeing that they are pushing volume growth despite the slow pickup in consumer spending. And we also see that they also improving efficiency, so that if they can't grow their top line as quickly as they would like to, then they would rather manage their cost actively and ensure that they bring down their cost of operation. And to that effect, we've seen them improve their manufacturing plants by bringing in more efficient technology for production, as well as even repackaging some of their products in smaller sizes. So overall, we think that Unilever, given the difficult operating environment, they are doing very well.
I mean, PZ also felt the pressure of a difficult operating environment, higher energy costs, higher input costs. Turnover is up 5.1%. Margin gains have improved, but the growth is quite modest compared to other stocks in this particular segment. What's your view on PZ?
Very modest, very modest. The growth for PZ, at the beginning of the year, we had looked at PZ, and considering their range of products and market segments and the stiff competition in that sector, vis-a-vis the fact that credits to private sector remains very low, and consumer spending as well has been very sticky. Based on those factors, our expectation for PZ was very modest for this year, and the result actually was generally in line with our expectation. Turnover grew by 5%, and PBT grew by 2%, and then PAT by just 1%. More or less a flat performance from PZ. They are proposing a dividend of 86 kobo, which is the same dividend that was paid last year, and it comes to about 52% of their, it's a payout ratio of 52%. And as well, we think that PZ will continue to face those kind of challenges, and part of what they are trying to do as well is to increase the level of promotion, so as especially in their white goods category, so that can help them to boost sales.
Okay, finally, Owando, indigenous marketer of oil products, profits after tax growing 25%, moving into new areas in the future like natural gas. They're excited particularly about the second half. Oil prices should be rising there because of the winter in the northern hemisphere. But it's also a time when we're going to get a little bit more clarity on the petroleum industry reforms. What are your expectations for Owando?
We think Owando is well positioned to take advantage of the reforms in the petroleum petroleum sector. And part of that is their new partnership with Exile as well, where they are trying to use that to improve their access to financing and as well as to push their upstream sector strategy further so that they can get better production in their E&P segment, that's exploration and production segment. But looking at the result in particular, we think that is generally in line with expectation. If you look at it on a half-year basis, they've been able to grow their top line by 55%, while the quarter-on-quarter performance is not as strong. It's just around 33%. We think the growth was largely driven by growth in crude oil prices, which has increased by around 40% in the course of the year, as well as slight improvements in their volume growth as well.